Welcome to the new tax landscape of 2024, a year of significant changes in the tax code that could impact your returns. The year 2024 brought us a fresh set of tax code revisions, each designed to shape the fiscal terrain. Let's unpack some of the key alterations and see how they might influence your tax returns. First on the list is the increase in standard deductions. In the past, taxpayers had the option to choose between itemizing their deductions or taking the standard deduction. But with the standard deduction having increased substantially, many taxpayers may find it more beneficial to take the standard deduction route. This change is expected to simplify the tax filing process for many, as itemizing deductions often requires more time and paperwork. Another key change in the tax code pertains to personal exemptions. In a surprising move, personal exemptions have been eliminated completely. This could have a significant impact on taxpayers, especially those with large families who previously would have received an exemption for each member of the family. Now, without these exemptions, taxpayers may find themselves facing a larger tax bill. But it's not all doom and gloom. The elimination of personal exemptions is offset in part by an increase in the child tax credit and the introduction of a new tax credit for non-child dependents, providing some relief for families. The tax landscape of 2024 is not just about deductions and exemptions. Changes have also been made to the tax brackets, retirement contributions, and even how you can use your 529 plan. Each of these changes brings with it a new set of considerations for taxpayers as they file their returns. In summary, the tax landscape of 2024 is a terrain of change. Increased standard deductions and the elimination of personal exemptions are major shifts that will shape the way we approach our taxes. Understanding these changes is critical to navigating the tax filing process and ensuring you're not paying more than you need to. Navigating the 2024 tax landscape requires an understanding of these fundamental changes. One of the most noteworthy changes this year is the shift in tax brackets. As we untangle the intricacies of tax changes in 2024, it's crucial to understand how the shift in tax brackets will affect different income groups. The Internal Revenue Service has adjusted the income ranges for each tax bracket to account for inflation. This adjustment, known as indexing, ensures that taxpayers aren't pushed into higher tax brackets simply because of inflation-induced income increases. So what does this mean for you? Well, let's say you're a single filer. If your taxable income is between $0 and $10,000, you fall into the 10% tax bracket. But if your income is between $10,001 and $40,000, you're in the 12% bracket. The range continues to climb, with the top bracket, 37%, applying to incomes over $500,000. Now, you might be thinking, wait a second, does that mean if I earn $1 more and shift into a higher bracket, I'll be taxed more on all my income? Not quite. The U.S. tax system is progressive, which means that different portions of your income are taxed at different rates, corresponding to these tax brackets. The shift in tax brackets means that the income ranges associated with each bracket have increased. For instance, the income range for the 22% tax bracket for single filers was $50,400 to $86,500 in 2023. In 2024, this range is now $51,800 to $88,250. This shift might seem minor, but it can have a significant impact on your tax obligations. By understanding these changes, you can better strategize your financial decisions and potentially lower your tax liability. Remember, taxes can be complex, and each person's situation is unique. For personalized advice, it's always a good idea to consult with a tax professional. Understanding your tax bracket is crucial for effective tax planning. Parents, pay attention. The child tax credit has undergone significant modifications. Now, in the world of taxes, change is the only constant. And one such change that's worth noting is the child tax credit. This credit, designed to provide financial relief to families with children, has been given a significant boost. If you're a parent, this could be music to your ears. The child tax credit used to be a maximum of $2,000 per child, but now it's been significantly increased. For parents with children under 6, the credit is a whopping $3,600. And for those of you with kids between 6 and 17, the credit stands at $3,000. Yes, that's right. The age limit has been expanded to include 17-year-olds. This increase in the child tax credit is not just about the numbers. It represents a commitment to support families, to ease the financial burden that comes with raising children. And this is a non-refundable credit, which means it can reduce your tax bill dollar for dollar. However, keep in mind the amount of the credit begins to phase out for individuals with modified adjusted gross incomes above $75,000, and for married couples filing jointly with incomes above $150,000. What's more, the credit is now fully refundable, meaning even if you owe less in taxes than your credit amount, you'll still receive the full amount of the credit as a refund. This is a significant change from previous years, where only a portion of the credit was refundable. And here's another key change. The credit can be received in advance monthly payments rather than waiting until you file your tax return. This can provide a much-needed cash flow boost for families throughout the year. These changes in the child tax credit can make a substantial difference in your tax bill. So, parents, it's time to revisit your tax planning strategy and make the most of these changes. Retirement savers, there's news for you. The 2024 tax changes have implications for your retirement contributions. The government has graciously raised the contribution limits for retirement accounts such as 401(k)s and individual retirement accounts, IRAs. This is a golden opportunity for taxpayers to optimize their retirement savings and reduce their tax liability. But how exactly does this work? Let's break it down. Think of your retirement contributions as a bit of a two-for-one deal. Not only are you setting aside funds for your future, but you're also potentially reducing your current tax bill. This is because the money you contribute to these retirement accounts is typically made with pre-tax dollars. This means your taxable income for the year is reduced by the amount you contribute. For instance, if you're in the 24% tax bracket and you contribute $5,000 to your 401(k), you could save about $1,200 on your taxes for that year. That's not chump change. In 2024, the contribution limits for 401(k)s have been increased to $19,500 for those under the age of 50 and $26,000 for those 50 and older. For IRAs, the limit is $6,000 or $7,000 if you're 50 or older. This increase in contribution limits gives you more room to save for retirement while simultaneously reducing your taxable income. It's like getting a discount on your future. Now keep in mind, there are rules and limits to these tax advantages. For example, there are income limits for contributing to a Roth IRA, and there could be penalties for withdrawing funds from these accounts before a certain age. But don't let these caveats deter you. The key is to understand the rules, plan wisely, and make the most of these opportunities. Reach out to a tax professional or financial planner to help navigate these waters. In conclusion, retirement contributions are more than just saving for the future. They're an integral part of your current financial strategy and can offer significant tax benefits. Maximizing your retirement contributions can provide substantial tax savings. In light of these changes, effective tax planning has never been more important. With the tax landscape in 2024 undergoing significant transformations, it's crucial for taxpayers to stay ahead of the curve. Tax planning isn't just about crunching numbers. It's about understanding how these numbers affect your financial future. First off, let's talk about preparation. The saying "knowledge is power" rings especially true here. Being aware of the changes, whether it's a shift in tax brackets or alterations to the child tax credit, allows you to anticipate and respond effectively. This could mean adjusting your withholdings or perhaps rethinking your retirement contributions. Next, consider seeking professional advice. Tax laws can be complex, and having a tax professional in your corner can ensure that you're making the most out of your tax strategies. They can provide insights tailored to your unique financial situation. Lastly, remember that tax planning is a year-round activity. Rather than waiting until tax season rolls around, make it a habit to regularly review and adjust your tax strategies as needed. This proactive approach not only prepares you for the tax season, but also helps optimize your overall financial picture. Proactive tax planning is key to navigating the 2024 tax landscape successfully. So arm yourself with the right knowledge, seek professional advice, and keep your tax strategies under constant review. Your future self will thank you.